Don't buy silver in February until you understand how January destroyed both bulls and bears in 48 hours. Silver printed a high near 121.64 and then collapsed toward the mid-80s, with intraday flashes even lower, all before the month was over. That is not normal volatility. That is a structural stress event, the kind that rewires markets, breaks leverage, and exposes who actually controls the plumbing. If you click away right now, you will do what most people always do after a violent month. You'll anchor to a single number. You'll tell yourself a story. It's cheap now. Or it's over. And you'll place a trade based on emotion instead of forensics. That's how investors become exit liquidity. Because January 2026 wasn't just a rally and a crash. It was a three-act operation. Fundamentals drove the first move. Speculation hijacked the second move, and then a synchronized liquidity shock took out the entire trade in the third. And if you want to survive February, if you want to know whether $85 is a bargain, whether $75 is coming, whether this bull market is dead or just recalibrating, you need to understand the exact chain reaction that took silver from the low 70s to $121 and back down in 31 days. In a few minutes, I'm going to show you the smoking gun sequence most people missed in real time, why the crash hit on that specific day, why it accelerated at the exact moment it did, and why the same mechanics can absolutely hit again in February, especially when seasonality and policy risk are stacked against you. Welcome back to the Dollar Watch. This channel exists for one purpose: to make sure you're not the person funding someone else's profits with your panic and your leverage. Subscribe if you want the February briefings as the data comes in, because this market is now operating in a higher volatility regime, and it will punish anyone who shows up unprepared. Now, let's do what the financial media almost never does. Let's treat January like a crime scene. When markets move this violently, the public wants a villain. Manipulation. Banks, algorithms. Sometimes those accusations are lazy coping mechanisms. Sometimes they're partially true. But in real investigative work, we don't start with the suspect. We start with the timeline, the incentives, and the mechanical triggers. So here's the framework. January had three distinct acts. Act 1 was January 1st through roughly the 20th, the phase where fundamentals still mattered and the rally had a coherent explanation. Act 2 was January 21st through the 29th, the phase where the move went parabolic, positioning got crowded, and retail mania entered. Act 3 was January 30th through 31st, the phase where leverage collided with a liquidity shock and the market imploded. If you can't identify which act you're in, you will always buy too late, sell too early, and blame the world for what was actually predictable behavior inside a leveraged market. Act 1 begins with a boring fact that becomes lethal when ignored. Silver doesn't trade in isolation. It trades inside a global industrial system, a global monetary system, and a derivatives system that is far larger than physical supply. That's why silver can be fundamentally tight and still crash 30% in a day. The paper market sets the price in the short run, and the physical market enforces reality over the long run. That tension is the whole story. So when silver opened early January around the low 70s, after a year that had already produced extraordinary gains, this wasn't just another uptrend. This was a market already loaded with prior momentum, already attracting speculators, and already sitting on top of multi-year deficits that had been patched over by draining above-ground inventory. And then the first catalyst landed: China's export controls. This is where you need the macro history, because without it, you'll misunderstand why silver suddenly became a geopolitical asset. Over the last 2 decades, China has repeatedly demonstrated a strategic playbook: dominate processing capacity, then regulate exports when geopolitical leverage is needed. We saw versions of this dynamic in rare earths. We've seen it in critical minerals. The underlying logic is brutal and rational. If you control the choke point, you control the negotiating table. Silver is not just jewelry. It's solar paste, electronics, electrification, defense components. It's embedded in the industrial policies that both Washington and Beijing treat as national security priorities. So when China reclassifies silver closer to strategic material behavior, tightening export licensing, narrowing the pool of authorized exporters, prioritizing domestic consumption, it's not a random bureaucratic change. It's economic statecraft. And the reason it matters is that China is not just a miner. It's a refiner. Refining is the real choke point. Ore is not the same as deliverable metal. If China's policy throttles refined silver exports, the West doesn't simply buy from somewhere else. It has to secure refined product, which takes time, capacity, and logistics. That's when premiums appear. And premiums are a signal the paper market hates, because premiums are the physical world voting against the screen price. By mid-January, Shanghai premiums over Western benchmarks widened dramatically. Under normal conditions, that spread invites arbitrage. Traders buy in the cheaper market, ship to the expensive market, and the spread closes. That's the textbook. But January 2026 wasn't a textbook environment. Export licensing friction, shipping lead times, and tight visible inventories meant arbitrage could not work at the speed required. The spread didn't close. It widened. That is the first alarm bell that the global silver market is not clearing smoothly. Now add the second catalyst, the COMEX inventory drain. This is where we have to talk about market plumbing. COMEX is a futures exchange. Most contracts settle financially, not with physical delivery. That's normal, but the system's credibility depends on deliverable inventory and the willingness of holders to make metal available when delivery demand rises. In other words, it's not about whether there is some silver somewhere. It's about whether there is enough deliverable silver in the right vault category at the right time to meet delivery expectations without triggering a confidence event. In early January, reported withdrawals from COMEX warehouses accelerated. The market started behaving as if immediate delivery mattered more than paper exposure. One of the most important signals in any commodity is when participants stop rolling forward and start pulling physical forward. That behavior says, I don't trust future availability at future prices. It's not greed. It's risk management by people who understand shortages, don't announce themselves politely. Now layer the math. Open interest in major delivery months can represent claims far exceeding registered inventory. That doesn't automatically mean fraud. It means the system assumes most participants will settle financially. But when confidence cracks, more participants request delivery. That's when ratios, hundreds of paper claims per available ounce, depending on how you measure, become more than trivia. They become systemic risk. Act 1, in other words, was not insanity. It was a rational repricing driven by tightening physical signals and a geopolitical shift that made global supply more constrained. This is why the early January rally looked almost disciplined. Silver consolidated, then broke out, then tested previous highs. The gold-silver ratio compressed, which is what you expect when silver outperforms, but the move is still connected to fundamentals. The buyers in this phase were not primarily tourists. This was the accumulation phase, the smart money phase, the phase where you can buy for coherent reasons and survive volatility because your thesis is real. And then Act 2 begins, and this is where people get seduced. Around January 21 through January 29th, silver stopped moving like a commodity and started moving like a contagion. The market added huge dollars per ounce in a matter of sessions. The speed of the move changed. The chart stopped breathing. It went vertical. This is where technicals and psychology take over. Silver crossing $100 was not just a number. It was a psychological threshold that triggers algorithmic behavior and human behavior. Algorithms see breakouts and momentum. Humans see headlines and envy. Crossing $100 also changes how the general public talks about it. At $30 or $40, silver is a niche asset. At $100, it becomes a cultural event. That's when attention becomes fuel. And attention is the most dangerous accelerant in markets, because attention attracts leverage. Now add the macro catalysts that poured gasoline on that fire. One of the most underrated drivers of precious metals is not inflation by itself, but the market's belief about real rates and currency policy. Silver and gold are non-yielding assets. Their opportunity cost rises when real yields rise, and their attractiveness rises when real yields fall or when currency credibility deteriorates. So when political messaging signaled comfort with a weaker dollar, whether explicit or implicit, markets took it as permission. And when the Federal Reserve held rates while leaving the door open to future cuts, markets interpreted it through their preferred lens. The tightening cycle is over, liquidity will return, the dollar will remain under pressure. That belief doesn't have to be objectively correct to move markets. It only has to be widely believed. This is where we need to remember a deeper history. Currencies are not priced like commodities. They're priced like confidence instruments. Since 1971, the dollar has been backed by policy credibility and the relative strength of U.S. institutions, not by convertibility into gold. That means messaging matters. It means expectations matter. It means when political leadership treats currency weakness as a feature, markets can interpret it as a green light for hard assets. That helps explain why silver didn't just rise. It sprinted. Meanwhile, Shanghai premiums surged again as Chinese buyers positioned ahead of Lunar New Year closures and procurement deadlines. That detail matters because when an entire region's market goes offline for a holiday, procurement behavior shifts. Buyers pull forward demand. They lock supply early. That can temporarily tighten global availability and widen regional dislocations. And then the retail flows hit. This is where the market stops being a negotiation between professionals and becomes a stampede. When retail money rushes into the most liquid proxy vehicles, big ETFs, high-volume tickers, the flow itself becomes the driver. The price goes up because people are buying, and people buy because the price goes up. That reflexivity is what creates blow-off conditions. This is also where narratives become dangerous. Silver squeeze. GameStop energy. Shorts will be forced to cover. Those stories may contain pieces of truth, but in a parabolic phase they mostly function as psychological permission slips for people to abandon risk management. And if you want the most important question of the month, it's this. When silver printed near $121, did you feel richer or did you feel safer? Because feeling richer is how you hold through the reversal. Feeling safer is how you take risk off before the liquidity shock. The market doesn't punish you for being bullish. It punishes you for being euphoric at the wrong moment. Now Act 3 begins, and this is where January becomes Silver Thursday 2.0 in spirit, even if the calendar doesn't match the 1980 mythology. Overnight, the macro narrative shifted. The president teased a future Fed chair nomination, and markets began pricing a different policy trajectory. Then the nominee was announced, Kevin Warsh, widely perceived as more hawkish than the dovish fantasies embedded in late January price action. Here's why that matters. Markets don't wait. Algorithms don't wait. Positioning doesn't wait. When the expected path of policy changes, everything reprices instantly. The dollar, yields, risk assets, and by extension, metals. If traders suddenly believe the era of easy money is ending, before it even begins, real rates can jump. And when real rates jump, the opportunity cost of holding non-yielding assets rises. That's a headwind for silver. Not because silver is bad, but because financial conditions are tightening. But that was only the front door. The back door was the real killer, a broader risk-off shock that triggered margin calls across portfolios. When a major tech bellwether sells off sharply, it doesn't just hurt tech investors. It hits hedge funds and family offices running multi-asset books. If they're long equities and long metals, and the equity book takes a hit, they need cash. They don't sell what they hate. They sell what they can. They liquidate the winners to cover the losers. That's how you get indiscriminate selling in assets that still have bullish fundamentals. This is the hidden mechanism behind many commodity crashes. The commodity didn't fail, the balance sheet failed. Now combine that with the most mechanical trigger of all, margin hikes. If you want to understand how a market collapses in hours, you must understand margin. A futures contract allows you to control a large notional position with a relatively small amount of collateral. That leverage amplifies gains on the way up. It also creates forced selling on the way down. When an exchange like CME raises margin requirements, it effectively demands more collateral immediately. That is not optional. If you can't post the cash, you must reduce positions. That means selling. And when thousands of leveraged participants are forced to sell simultaneously, you get a liquidation cascade. This is not theory. This is how 1980 happened. This is how 2011 accelerated. And this is how January 2026 broke. The key here is timing. Margin changes announced into a market already overextended and already wobbling under macro repricing can turn a pullback into a cliff. A trader who bought near $115 or $120 with leverage is already underwater after the first downdraft. Now you tell them to post an extra 5 figures per contract. Most can't, so they liquidate. Their selling pushes price down. That triggers more margin calls. Those calls trigger more liquidations. The feedback loop feeds itself. That's why the decline looks irrational from the outside. From the inside, it's perfectly rational. It's margin math. And then, as brokers see the carnage, they tighten leverage further. That sounds like prudence. It is also gasoline. Because if a brokerage slashes allowable leverage, clients are forced to de-risk immediately, regardless of conviction. That accelerates the unwind, so silver collapses into the mid-80s with intraday chaos. And the story spreads beyond the West. This is the part most American investors ignore, and it's a mistake. Commodities are global, and when a commodity goes parabolic, regional leverage hubs can blow up. In places where silver trading is culturally embedded and margin practices are aggressive, a violent move can trigger insolvencies, firms unable to settle obligations, counterparties scrambling, credit lines questioned. These are not just local tragedies. They're signals that volatility is propagating into the real economy. When a market event forces firms to shut doors or default, it tells you something uncomfortable. This wasn't a clean, orderly market correction. This was a liquidity event. And here's the wicked irony. The crash didn't just destroy the late bulls who bought at $120. It also destroyed bears who shorted silver thinking it couldn't possibly go that high. That is how parabolic regimes kill both sides. They don't reward cynicism. They reward proper sizing and proper respect for tail risk. Now step back and look at what January printed on the monthly chart. A long upper wick. A classic shooting star style candle after a parabolic run. It represents rejection at higher levels and exhaustion of marginal buyers. These candles don't predict the future with certainty. But historically, when they appear after a blow-off, they often signal a period of consolidation or continued corrective behavior. In other words, January may have ended the easy money phase of this rally, not necessarily the secular bull market, but the clean one-way trade. And that brings us to February, which is where most viewers are about to make their next mistake. Because after a crash, your brain wants closure. You want one price, one answer. Buy here. Sell here. Markets don't give closure. They give consequences. February has 3 major forces acting on silver simultaneously. Technical damage from January's blow-off, macro uncertainty tied to Fed leadership and real rates, and seasonal weakness that has historically made this period hostile to silver longs. Let's talk about seasonality carefully, because it's not magic and it's not destiny. Seasonality is the footprint of human and industrial behavior. Fabrication cycles, holiday closures, procurement timing, inventory management. It's a probability tilt, not a guarantee. But when seasonality aligns with technical damage and tightening financial conditions, you get a higher probability window for continued downside pressure, or at least violent chop that destroys impatient traders. Post-January profit-taking is one driver. Lunar New Year closures removing a major demand center temporarily is another. Winter fabrication patterns in parts of the northern hemisphere also matter at the margin. The net effect is that February often becomes a digest the rally month, and after a month like January, digestion can be ugly. So what levels matter now? First, the mid-80 zone. This is where price stabilized after the liquidation. It's where buyers first showed up after the freefall. Former resistance can become support, but only if confidence holds. If this zone breaks cleanly on heavy volume, it opens the door to deeper retracement. Second, the mid-70s zone. In many blow-off moves, a 50% retracement of the vertical leg becomes a magnet. Not because Fibonacci is mystical, but because human positioning and risk limits cluster around obvious retracements. If the market needs a final washout to purge remaining leverage, the $75 to $78 neighborhood is a plausible battlefield. Third, the low 70 zone, roughly where January started. If silver returns there, it means the entire parabolic phase has been fully unwound and the market is asking a different question. Was January a premature squeeze or the first violent step into a higher long-term regime? A breakdown below the January base would signal deeper corrective risk. A hold there would be the kind of reset that longer-term bulls often need to rebuild positions without being destroyed by volatility. Now on the upside, resistances matter too, because rebounds after liquidation can be savage. The first upside zone is $95 to $100. Round numbers matter because humans matter and because algorithms are coded by humans. Reclaiming $100 would restore bullish psychology, but it would also invite another wave of speculative attention. The market may not be ready for that yet. Then there's $110 to $115, the prior consolidation zone before the final parabolic sprint. Markets often retest these launch pads. If silver can reclaim and hold that zone on stable liquidity, the case for a higher base strengthens. If it fails there repeatedly, you're looking at a market still in repair mode. And the all-time high near $121.64? In February, absent a fresh shock catalyst, a quick retest is less likely, not impossible, but less likely. Markets usually need time after a liquidation event. They need to rebuild collateral. They need to rebuild confidence. They need to rebuild inventory flows. Parabolic highs are not casually revisited right after a crash unless the underlying shortage becomes acute enough to override financial tightening. Now, there are key dates in February that can trigger volatility regardless of what the chart should do. Broker and exchange leverage constraints tightening further can force mechanical selling. Lunar New Year closures can temporarily reduce visible Chinese participation. Fed minutes and messaging will be scrutinized for the direction of real rates. And Kevin Warsh's confirmation path, hearings, Senate pressure, political bargaining, matters because it influences the market's forward view of monetary policy. Even the perception of a more hawkish Fed chair can tighten financial conditions through expectations alone. This is why I'm telling you not to blindly buy silver in early February just because it's down. In a post-liquidation environment, cheap can get cheaper purely through mechanics. Now, let's weigh the cases for February without pretending certainty. The bullish case says the crash was an overshoot. Liquidations pushed price below where fundamentals would clear. If that's true, we can see a reflex bounce as shorts cover, as oversold technicals mean revert, and as physical tightness reasserts itself. Veteran traders sometimes look for this kind of rebound after a forced liquidation because the selling was not voluntary. It was compelled. But even in a bullish case, the rebound doesn't guarantee a straight line back to highs. Post-crash markets are typically two-way markets: violent rallies, violent drops, chop that bleeds anyone who trades too large. The bearish case says the parabolic move was a bubble phase on top of real fundamentals, and the bubble has not fully deflated. If open interest remains elevated and speculative positioning remains crowded, the market may need one more flush, a final washout that pushes into the 70s before a durable base is built. If February seasonality and real rates stay hostile, that scenario becomes more plausible. The truth is likely messy. A February range with a downward bias, punctuated by sharp bounces and sharp drops as the market transitions from mania to structure. And this is where we talk about your strategy, because this isn't a spectator sport. If you hold physical silver for long-term wealth preservation, your job is not to day trade chaos. Your job is to avoid being emotionally manipulated into selling scarce assets for depreciating currency during a temporary liquidity event. Physical is not a 31-day thesis. It's a regime thesis. If you're trading silver with leverage, January should have scared you straight, because leverage is not just risk. It is a time bomb that depends on other people's liquidity. If you cannot withstand 20% to 30% drawdowns without being forced out, you do not control your position. The exchange and your broker do. If you're looking to build exposure in February, the professional approach is not all in. It's scaling, it's patience, it's recognizing that the easy money was made in Act 1 and the easy money died in Act 3. What remains is a brutal market where discipline matters more than conviction. And now, I'm going to give you the single most important lesson from January, because if you internalize it, you'll stop donating money to the market. In a parabolic market, the chart is not just a chart, it is a map of leverage. When price rises too fast, leverage accumulates. When the macro narrative shifts and margin tightens, leverage is forced out. The forced outflow becomes the crash. The crash is not the end of the bull case, it is the end of the naive phase. That's why I don't need you to memorize every number. I need you to understand the mechanism, because the mechanism is what can repeat. China tightens exports, premiums rise, arbitrage fails, inventories drain, silver rallies. Then speculation piles in, leverage grows, the dollar narrative shifts, real rates jump, equities wobble, margin requirements rise, forced selling begins, and the market collapses. That chain reaction is your playbook, not to predict, to prepare. So here's what I want from you. In the comments, tell me your February plan in one sentence. Are you scaling in between $80 and $85? Are you waiting for $75? Are you staying in cash until late February when the seasonal window begins to shift? Or are you holding what you have and refusing to trade a two-way market? And if this forensic breakdown clarified what happened in January, hit like. Not for vanity, because the algorithm only surfaces sober analysis when viewers explicitly reward it. The bull market may not be dead, but the easy money is gone. February is for accumulation, not adrenaline. February is for capital preservation, not bravado. February is for people who understand that the market's job is to transfer wealth from the impulsive to the prepared. Stay sharp, keep your sizing sane, and in the next briefing, we're going to track the first week of February in real time, because the next trap won't announce itself. It will feel like opportunity right before it becomes punishment. Act.